Many of the people watching this video spend a lot of time deciding what you want to invest in. Stocks, bonds, passive index funds or active funds, large cap, small cap, US, international. But there's another question that often gets far less attention. Should different investments be held in different types of accounts? So today, we're talking about something called asset location. And according to research from Vanguard Group, in their article that's titled Revisiting the Conventional Wisdom Regarding Asset Location, I know, fun name, they state, our analysis demonstrates that a thoughtful asset location strategy can add significant value in increasing clients' after-tax wealth compared to an equal location approach. The statement that caught my eye on that was that the statement significant value that they used, and that's regarding the asset location. So I'm your host, Eli Freeman, a certified financial planner, and this is Data Brief, where we break down the data behind investing so you can make better decisions based on facts and not feelings. As always, let's look at the data. So today, I'm going to help break down asset location. We'll talk about the different types of investment accounts, how investments are taxed differently, and whether placing certain investments in certain accounts can actually improve long-term outcomes for you and your family. Most investors are building wealth across 3 different tax environments, and each one treats investments differently. The first is a taxable account. This is typically a brokerage account, but a lot of people may call it something like an individual account, a joint account, or a trust account. And every year, you typically owe tax on dividends, interest, and if you sold something, you may realize a capital gain. Long-term capital gains may receive favorable tax rates, but taxes can still create something called tax drag, which is consistent taxes owed on dividends and gain, which slowly can reduce how much your investments compound over time. Taxable accounts do have some advantages though. They allow for tax loss harvesting, and they benefit from preferential capital gains rates instead of income rates, and they may receive a step up in basis for beneficiaries. If you're curious into a deeper dive into these accounts, I've actually created a video that's called One Account That's Almost Always Ignored. If you're curious about how to optimize this account specifically, that video is for you. The second category is retirement accounts that are tax deferred. These include accounts like a 401k retirement plan or a traditional IRA. With these accounts, you typically receive a tax deduction today, but withdrawals in retirement are taxed at ordinary income. The advantage is that investments can grow without annual taxation while they remain inside the account, but the trade-off is that when the funds are eventually withdrawn, they're taxed at whatever your ordinary income rates happen to be at that time. The third category is tax-free accounts. These include accounts like Roth IRA or Roth 401k. And the tax treatment on these is essentially reversed from the traditional IRA. You pay the taxes up front, but once the money is inside the account, the growth is tax-free, and all withdrawals that are qualified come out tax-free. This means that these accounts can be extremely powerful places for long-term compounding. So those are the 3 different accounts, and coordinating those 3 accounts can be the part that takes a little bit more effort. Most investors are familiar with asset allocation, which is how you divide your portfolio between different investments. For example, a portfolio might be 60% stocks and 40% bonds, but asset location is different. Instead of asking what investments should I own, it asks which accounts should I hold those investments. 2 investments could hold the exact same portfolio, the same stocks, the same bonds, the same asset location, but depending on where those assets are placed, one investor could end up with more after-tax wealth than the other. And the reason comes down to tax treatment. Not all investments are taxed the same. For example, bonds typically generate interest income, and that interest income is usually taxed as ordinary income, which may be taxed at higher rates for individuals than capital gains. Stocks, on the other hand, often produce qualified dividends and long-term capital gains, which may receive the more favorable tax treatment of capital gains. Broad market investments such as the S&P 500 are relatively tax efficient, particularly when they're held for long periods of time. Because of these differences in tax treatment, the placement of investments across accounts can matter. Historically, a common rule of thumb has been to place bonds in tax-deferred accounts, stocks in taxable accounts, and high-growth assets in your Roth accounts. And the logic is simple. Place the least tax-efficient investment in accounts where taxes are deferred, and place the most tax-efficient investment in your taxable accounts and Roth accounts that grow tax-free. Over long periods of time, that approach can reduce the tax drag on a portfolio. But how much does that really matter? And this is where the research from Vanguard Group can become helpful. Their analysis looked at how different asset location strategies affect after-tax wealth, and I'd encourage you to go read it for the very specifics. But while the results vary depending on the investor's account makeup and risk tolerance, the benefits tend to be largest for a few specific groups. And the first group is investors in higher tax brackets. The higher tax rate, the greater the potential impact for tax-efficient placement. The second group is investors who plan to leave a significant portion of their taxable assets to beneficiaries. Taxable accounts may receive a step up in basis at death, which can eliminate capital gains and taxes on prior appreciation. That can make taxable accounts particularly valuable for assets that may eventually be inherited. And the third group of investors is those with a more balanced portfolio, meaning portfolios that include both stocks and bonds. If someone holds a portfolio that is entirely equities, there are fewer opportunities to optimize placement because there are fewer choices to be made. But when a portfolio includes multiple asset classes, asset location becomes more impactful. And one of the most interesting findings from the Vanguard study is that the conventional approach still works well for most investors. Their conclusion states, "We find that for most investors, the conventional rebalancing strategy is still wealth maximizing." In other words, simply maintaining your asset location across accounts and rebalancing when necessary will often lead to strong long-term outcomes. However, there was one notable exception. The exception occurs for investors who use active equity strategies and who expect to spend a significant portion of their assets during their lifetime. In these cases, the research suggests that a different asset location approach may sometimes actually be preferable. Specifically, instead of placing bonds entirely in tax-deferred accounts, it may make more sense to place more equities inside Roth accounts, while shifting some bond exposure into the taxable accounts. The reason is that if equities generate higher long-term returns, placing them in a tax-free environment like a Roth account allows that growth to compound without taxation. Meanwhile, some bond exposure in taxable accounts may not be as detrimental depending on tax rates and the structure of the portfolio. But again, this depends heavily on an individual's tax bracket, asset allocation, and spending assumptions. So at the end of the day, most investors focus on what investments to own, but the data suggests where those investments are held can also influence long-term wealth creation. According to the research from Vanguard Group that I've referenced multiple times, a thoughtful asset location strategy can increase after-tax wealth compared to simply spreading investments evenly across accounts. It may not change your investment strategy itself, but it can improve how efficiently that strategy compounds over time. And when it comes to long-term investing, even small improvements in efficiency can add up to meaningful differences.